Good afternoon, everyone, and welcome to another episode of Keeping It Simple with Simplify. Today's guest is Anupam Ghose, who is the managing partner and co founder of System 2 Advisors. If you're not familiar with System 2, they're a hedge fund established in 2011 who manages Indian strategies. They're also the sub advisor for our India strategy. And today we'll be discussing economic dynamics and investment opportunities in India. But before we get started, a quick couple of housekeeping items. If you have any questions, please submit them over the Q&A function on your screen and we'll answer them as we go. And also, this conversation today is meant to be informative and entertaining. It's not financial advice. So without further ado, over to you, Mike.
All right, fantastic. Not financial advice, informative and entertaining. We've got Harley here for that.
The entertainment part.
Ah, yes, exactly. Anupam, it's a pleasure to have you here.
Thank you, Michael.
Now you're joining us. It's 2 a.m. your time in India, correct?
That is correct. I'm speaking to you from New Delhi, 2 a.m. on Friday the 14th.
All right, fantastic. And Harley, you've been to the New Delhi around the corner there, haven't you?
I actually was in India for 2 weeks a few years ago. My boy had a 6-month posting in Bangalore.
Okay.
All right, fantastic. Okay, well, as Bobby had indicated, Anupam is the managing the portfolio manager for our India Opportunity Fund at Simplify, our strategy focused around developing markets. And we're thrilled to have you here. Just very quickly, I wanted to give a brief update and introduction. So let me share just a few slides here. I'm going to start off with sharing the screen, which of course now doesn't want to go. There we go. Let's see if we can get this up. All right. We're going to do this one more time here. And excellent. Okay, so Anupam, can you give quick background to System 2 Advisors and tell us just quickly about the founding of the firm, how long you've been doing this, what the emphasis is, etc.
Sure. Thank you, Michael. As a business, we were formed in 2011. We've always had a fairly substantial presence in the ground in India. We started out in the city of Chennai with a sort of team of research analysts. We got into trading India in 2015, and we launched a hedge fund on India in 2016. In 2020, we launched an active long-only product in India, which is the strategy for which is the basis for our sub-advisory work on the Simplify India Opportunities portfolio. Currently, we have 4 offices in India, in Chennai, India, which is the first one, Mumbai, which is our largest office, New Delhi, and Kolkata. We have approximately 65 investment professionals and support staff across these 4 offices. And the pivot to India essentially took us out of competing in more developed markets into higher alpha emerging markets, where we certainly had an advantage with the boots on the ground, with our sort of deep India heritage and our understanding of the India markets. Hedge fund has been quite successful. Over the last 8 years, we've had one down quarter. It's a long short market neutral hedge fund. And between the long only product, which started in 2020, and the hedge fund product and some proprietary trading that we do have deep India expertise in the alpha generation space, and we manage across these 3 lines of businesses a little over $600 million.
Fantastic. And you've come roaring out of the gate with the strategy managed for us, putting up absolutely fantastic numbers in a start. Maybe we can very briefly take a poll at this point, just to familiarize ourselves with the audience and kind of how they're thinking about things. Could we toss up our poll question first? One of the key questions is obviously this dynamic of, will India's GDP ultimately exceed China's? And so just by 2050, put down what you guys think is the answer. We'll talk about a little bit of the details here, but there's some amazing information around India in terms of the relative growth rates and the overall opportunity. But let's pause for 1 second to answer this question. I'm not sure if we got the second question into our poll. Look at that.
Wow.
Wow, nearly universal. I don't think I've actually seen that type of margin on one of our questions before. Do we have the second question in terms of emerging markets as well? Okay, this was my question that unfortunately we don't have, which was the question of emerging markets. So I know, maybe you can give us your perspective, because one of the things we've heard over and over again over the last decade is it's time for emerging markets, right? Having seen the last emerging market run kind of end around the global financial crisis with a brief rebound in the few years afterwards, it's been all about the US markets for the most part, right? Now, India has done extraordinarily well in the context of that, but it really has been about the US markets. The actual question was a joke. India, it's time, or emerging markets, it's time, or emerging markets. NVIDIA kind of sounds Indian, right? So, Anupam, if you were to think about that question of, is it actually time? Is there a reason why people should be seeking diversification away from the United States at this point into India, in your opinion?
Thanks, Michael. I've long held that in my 30 plus years of in this business, that diversification is the only free lunch. Again, given that we have deep home country biases, and I've lived in the United States now for the last 30, 35-ish years, as a student, as a young professional, and now an old professional, home country biases are always difficult to overcome, but a basket of investments that includes both home country and non-home country certainly does work. Is it time for India? Again, India is uniquely positioned today because of accelerating GDP growth due to its demographic dividend. That, if you've got a country that is a $3.8 trillion economy that's growing at approximately 7.5 to 8%, do you want that in your portfolio or not? That's the question. Now, in sharp contrast, you see everything good with the United States. Obviously, you've got very narrow leadership in sort of the AI and tech sectors, but the macroeconomic situation in the United States, especially with inflation, with deficits, etc., do not paint a very pretty picture. Now, I never thought I could say this in my lifetime, but inflation in India is below that of the United States, and the fiscal deficits in India, by some measures, are below that of the United States. Now, so the question is, does India have a place in your portfolio? The answer is absolutely yes to that. What percentage should that be? We think it should be growing, but again, that's left to the advisor, not to us.
Well, now, if I were to look at it on the global stock market basis, right? So total assets across the global stock market are somewhere in the neighborhood of $110 trillion, if I remember correctly. And India's total stock market capitalization is approximately 4 trillion. Is that about right?
It's around it. It could be slightly higher than that, yes.
Slightly higher than that. Okay. And so you're looking at a place that now contains, if my math is correct on this, somewhere around 20% of global population, 15% of global population, and yet represents less than 5% of total global stock market capitalization. And that's against an environment in which, if we are thinking about kind of the fundamental components that you're hitting on, this is a country with extraordinarily favorable demographics, a growing middle class, and a growing economy. The rate at which that growth is occurring is really amazing to me. The first thing, and I almost titled this, by the way, 1.5 billion people that can't be wrong. But you've now got an audience here that is 1.4 billion people. The middle class is growing rapidly. Is it an advantage or a disadvantage for India to be a democracy in your mind?
Michael, that's a great question. And I think we uniformly believe that, democracy is sort of a messy system of government, but still the best that we have globally. And India is, like the United States and like Israel, a multi-ethnic, multi-plural, sort of multi-party democracy. We just had the elections where approximately 70% of the 940 million eligible voters voted. That's an exercise which is incomprehensible by science, but anyway, that's something that we've gone through. Democracy, on the other hand, and market economies, which are almost intertwined, are not always the best for growth in the short run. Authoritarian governments, we've seen military dictatorships in South Korea and other countries drive economic growth, without any, and this I'm talking about a little while back. We've seen that happen, where they've driven economic growth much faster than democracies would or market economies would. But we believe that in the long run, market economies and democracies, and I use that interchangeably, are the best allocators of capital. Best allocators of capital to not have, the huge problem of the state allocating capital, to favored sort of, sectors, et cetera, et cetera. And here, while India is somewhat of a free market, the government still is a major force, in the economy. Less, sort of certainly its participation in the government, in the economy is going down. But you've certainly seen sort of industrial policy come back to the United States, and suddenly the government in the United States getting involved, in the economy in a much bigger way, And of course, the 30 years that I've lived, in the United States from the George H.W. Bush government, when I went there permanently as a student, the size of government in the United States has continued to grow compared to the academy. So, Michael, to your question, democracy is not perfect, for the fastest economic growth, but in the long run, significantly more efficient allocation of capital in private hands, and overall better for the population.
Can I expand on that for 1 second?
Yeah.
There's a kind of a theory of thought that countries that have per capita GDP of 8 to 12, somewhere there's like a fulcrum, and below that, they tend to operate better as a command and control. South Korea is exactly the example. And once you get above $10,000-12,000 per person per capita, you want to go have a democratic form of government, because the economy is just too big, too complicated for one guy to drive it. And this is exactly what I think what China has done. And the weird thing about China now is they're getting to this point where maybe they can't operate as a command and control. I'm really this idea of India. What is the GDP per capita? Has got to be what, 3,000 or 4,000?
It's about 2,500 or somewhere in the 2,000.
I kind of wonder if they actually can operate as a democracy there. It's just too many ants all running around.
Okay, Harley, I have a slightly different view, and what you're describing is more of a. I'm going to take the other side. I'm not a proud, but I'm a dropout of a PhD program in economics. I do have a master's in economics, so and somewhat of a student of demographics. And the whole demographic dividend phenomenon is quite simply that once you get to about $2,000 of per capita GDP, discretionary consumption sets in, which drives economic growth and takes GDP from $2,000 per capita to $6,000 per capita in almost in a straight line, which translates to about 10% growth over 2 decades. We saw that in China, 95 to 2015. And as you mentioned, Harley, when you enter the 8 to 10,000, that's a middle income trap.
Right.
That's a middle income trap. And a lot of countries do not get out of the middle income trap. Again, I'm not an expert on whether what form of government is the best, but my understanding of the demographic dividend is that it happens irrespective of the form of government, irrespective of commodity prices. Our only point of reference is China, because we've observed it recently. But the United States, or the United Kingdom or France or Germany, any of these countries have undergone and witnessed sort of demographic dividends. Obviously, some of this happened like 100, 200 years back. I don't know the exact time, but it happens in spite of the form of government. So to your question, whether an authoritarian, a centralized command and control economy is better, in this rapid growth stage between $2,000 and $6,000 or $8,000, and democracy better after that. I'm unfortunately not, I haven't studied it, and I'm not an expert on that, but I would somewhat point to it as more of a, demographic dividend story. And if you look at countries that are going to enter the demographic dividend after India, countries like Egypt, countries like Nigeria, countries like Saudi Arabia, these are all, Saudi Arabia is a slightly different case, but you're going to see rapid growth because of the young population and discretionary consumption setting in, et cetera, et cetera. Egypt and Nigeria and Saudi Arabia are slated to be next, and they have very different forms of government. Well, I do believe that.
I don't want to distract Mike from his path, but I want to ask one more question from 30,000 feet. I get China, 20 years ago. China is selling, we got the cheapest labor on the planet, and we're kind of organized and kind of do this thing, we can make stuff. The US, like we have ideas and patents that all get stolen. China's wages have gotten to a point now where we're moving out of China to Vietnam, which we would have done either way without the COVID. Sure. I'm trying to wonder, what is India selling? Is India selling technology? Are they selling cheap labor? Or what is the India story here?
Sure. Harley, the India story is quite simply the following. Let me tackle the first part of the question. As sort of the Western love affair with China, has sort of cooled considerably, and so the supply chains are reorienting towards more friendly shores. Whether it's Mexico, whether it's wherever it may be, any supply chains which have relatively low skill labor content are moving to countries like Vietnam, like Cambodia, like Laos, et cetera, et cetera. The businesses or the supply chains which require high labor content, high skill labor content, those tend to move to India because of the very large educated population, especially in technical. The country produces in the hundreds of thousands. I believe the number is 240,000, some number like, of engineers every year. So anything that has a very large component which requires skilled labor, specialty chemicals, pharmaceuticals, etc. Those are the ones moving to India. What India is selling simply is today is a very, very sort of fast-growing domestic market. So you've seen the likes of Apple now start assembling phones in India away from China. Amazing phenomenon. 3 years back or 4 years back, I forget the exact date, where not a single iPhone was assembled in India. Last year, India exported something like $15 billion worth of the iPhone 14s. But part of that is sort of geared towards, and sort of, cheaper price points in the Apple sort of lineup are geared towards the domestic economy. So what India offers is a large domestic economy, which is growing rapidly. So consumption is happening here. The consumption is happening here, while cheap qualified labor, which it has high skill sort of content, which is for export. Things like Hyundai Motors, the South Korean, automobile giant, which sort of started out in India, a while back, outside of South Korea, it's the largest manufacturing units for Hyundai, and almost all its, lower end, cheaper exports to Africa, Latin America, and the emerging markets happen out of India. The other example there is in the automobile sector is Suzuki, which is mostly known as a motorcycle company, set up shop in India to manufacture smaller cars, things like 800cc cars, etc. That unit went public and has a market capitalization bigger than Suzuki in Japan. Just like Domino's Pizza here at one point had a higher market capitalization than Domino's in the US. So what it sort of really sort of, what does it offer is, sort of deep pools of qualified, relatively inexpensive labor.
So when you think about that type of dynamic, and I think part of what Harley is highlighting is this traditional dynamic between, what we would think of basically as an Adam Smith free market framework and a Colbert type system, right? Which is a directed national development component. It becomes much easier to do the directed national development in a country like Singapore that is much smaller in terms of its aggregate scale, that has unique features and advantages in terms of its port operations. But for a country the size of India, and even China for that matter, if we allow or if we encourage too much of a state-driven investment cycle, you effectively end up with a very imbalanced economy, right? And so India has some checks on that have limited its ability to launch forward because people argue, right? That's what a democracy is about. That's what a free market is about, is people sending signals to the economy in a variety of ways. That can be overcome, that natural fractiousness can be overcome by a single authoritarian leader. I often use the expression, an authoritarian form of government is simply seeking efficiency within the public sector. You're tired of debating what you're going to do, and you simply do it. Now, that can lead you in multiple directions. It can create conditions under which you have a small tyrant emerging. It can create conditions under which choices are made on a national direction basis, like the imbalance that's currently developing in China with the emphasis on exports and finance that the rest of the world simply is not willing to accept. And I would actually argue that part of the story, and we see this very much in terms of the dynamics of foreign direct investment in India. I'll just jump to the actual slide so you can see this. The foreign direct investment in India, this to me is just an astonishing number. This is in US billions. By 2022 at 85 billion, if we went 15 years before that, we were less than 10, right? So you've seen more than an 800% increase in this type of foreign direct investment that is building the factories, et cetera. Is a similar savings pattern happening inside India, where they're directing a significant quantity towards infrastructure improvement, the export sector, the development of the consumer sector, et cetera? You mentioned a highly educated population relative to many emerging markets. One of the things, obviously, that's an advantage that India has is a large English language speaking population as well. How do you think about the development path of India in that context?
Michael, a great question, and it's slightly paradoxical because almost 60% of the population in India is rural and involved in agriculture, which is only 17% of the GDP. However, that's the vote bank that puts governments in power. So there's a fair amount of social spending, et cetera, that has to happen, which detracts from more productive ways. The best way to think about India, Michael, is it's a collection of 600 kingdoms woven into a country by the British by imposing common language. English is spoken almost everywhere, and common English law, which has persisted. I got the first sense of this, when I was in business school, and Jim Rogers had just finished his investment biker tour, and he thought of India more as, the Balkans rather than as a country by itself. So it is loud, noisy, fractious, and very difficult to govern. 27, provinces or 27 sort of states in India, 16 major languages, each with their own script. If you go to the south of India, the southern 4 states, you don't speak any English, you will not be able to understand a word of what is being spoken there. While the northern Indian languages are mostly Sanskrit derivatives, So to that sort of, India from its independence in 1947 was set up in such a way, in a decentralized way, where central sort of, authority, especially military power, was very difficult to consolidate for anyone. Like, it's almost by sort of design that, it's a difficult country to govern from, or to, for a dictatorial or authoritarian government to control from one side. If that did happen, the country would sort of break apart, almost immediately. So moving forward, sort of, it's not just sort of, foreign interest in India that's going, it's domestic interest in India, and all the policy reforms that have happened now over the last, say, 15, 20 years. And I'll point to some, and I'll give you an example there. I'll give you examples there. If you go back about, sort of 20 years, or maybe even 30 years, which is almost a generation, household balance sheets in India comprise largely of real estate, gold, and certificates of deposit from blue chip companies. Equity market participation was very, very little. All the reforms that came in under the first Modi term, and all the digitization that came in for KYC, AML, and the ease of doing business, etc., all that started, a process of moving, away from tangible, assets like real estate and gold to more sort of financial assets, and participation in the markets began to rise. It's still very, very, underpenetrated, equity exposure in India, and I'm sort of drawing the linkage between, the domestic population investing in equities, which in turn is getting invested in as sort of corporate capex, etc. The government has been, very, very, very aggressive in sort of building out infrastructure. As you see today, there are about 140 airports in India, almost 100 of which have been built in the last 10 years, but there are 85 major airports under construction as we speak, and there are 50 cities getting new metro systems. It's all funded by, the government and some in public-private sort of partnerships. But coming to the point, Michael, about foreign direct investments by foreigners into India, that is slowly but surely becoming a smaller part, or not as influential as what domestic sort of investments are. About 10 years back, the only component of the equity markets that really mattered were foreign portfolio investors. Today, domestic institutions are much more powerful in sort of how the markets move. So there is more sort of secular shifts going on there. While foreign direct investment has grown quite rapidly, domestic investments across sort of all asset classes is also dominant.
So one of the things that you brought up is this dynamic of urban income environments, the difference between a rural environment from where Modi largely draws the voting base, right? This has actually been a pretty important factor in this last election, was the relative deterioration of Modi's standing, because his support is skewed towards, to your point, I believe, the north, and towards the more rural environments, the less wealthy urban environments. Correct me if anything I say is wrong, because I'm not an India politics expert. But within the context of that, where we're actually seeing this extraordinary growth is largely in the urban population, right? That's where to your point, the disposable income that effectively allows consumers to vote with their wallets, as compared to living off of a subsistence farm in which very few market purchases are made. Instead, suddenly, when you move into the urban environment, you're directing capital on a consumption basis that is actually quite helpful for the build out of a domestic business as compared to a purely export-oriented business. Now, the export can often come alongside that, right? It can be quite powerful to have that development as an accompaniment. But really, the secret here is actually the growth of that urban environment. You mentioned the 85 airports that are being built. This is also another component that I would highlight. You mentioned it has been unusual in your lifetime to think of the idea of India having a lower inflation rate than the United States. It would be unusual in your lifetime to think of the dynamics of India running a smaller deficit than the United States. The way that India is spending that deficit is quite different than the United States as well, though, isn't it? Because the US deficit is largely now being spent on a combination of interest expense, and it's being spent on effectively transfer payments to the old and the infirm in the United States, right? These are largely Social Security and Medicare type payments alongside interest expense in the United States. In India, you're running a deficit because you're actually building infrastructure. Is that a fair characterization?
Absolutely. It's a fair characterization. And Michael, you mentioned the election results, and I was very fortunate to be in India and watch the election results. The exit polls, which were sort of last week on Monday, and the actual sort of vote tally where there was a significant difference. Markets did fall 6%, on that day on the poor poll results for Modi, and have subsequently sort of bounced back and are scaling all-time highs. But to that point, Michael, there's tremendous growth in infrastructure, that's being funded by the government, and unfortunately, though that is urban investments, which benefits urban sort of populations and the asset owners in the urban in the urban centers rather than rural. And as I mentioned, it's only 40% of the country that's urban compared to 60% that's rural. But the vote banks are significantly in the rural sort of sector. Modi, for the large part, had been able to push forward the notion that India's gone beyond, religion and beyond casteism and all the things that sort of bedeviled us, before, to move into economic growth. And he promised a brighter economic future, for everyone, more on an inclusive basis that was bought. That's how he got the majorities in the last two elections, there was again, India's as polarized as a country as the United States is, or other noisy democracies are. We're seeing some fairly, phenomenal and unprecedented results. For example, in France, in the European elections, this was unimaginable 10 or 15 years back with what Marine Le Pen has done. But in India, this time around, there was perceived to be a major weakness in the Modi government in just pushing the economic growth message. The opposition, which is still very fractured, but still powerful, they were able to push forward, the notion that in the event that the Modi government got a 2/3 majority and were able to amend the constitution, a lot of the what we call here, sort of lower caste people for whom there's reservation in education, in jobs, etc., that those would go away. And they were able to essentially, scare, if you want to call it that, use the scare tactic and say, hey, you vote for Modi, you may lose, whatever economic sort of progress you made. So that was quite effective. But the urban-rural dilemma here is quite quite well understood, quite pronounced. And every time the pendulum shifts one way, the elections have a way of essentially rebalancing it and pulling it back the other way. You will see increased rural spending, increased transfer payments, etc., to the rural economy in the next 5 years, only because that's where the election results are. And is that good overall for short-term economic growth? The answer is absolutely not. But in the long term, the redistribution of wealth, through a democratic process does help.
So that I think is actually a great point, which is effectively that we prevent, through that process, we actually prevent the type of schisms or fractures that could occur were that growth simply to be directed towards the export sector or the capital investment cycle as compared to sharing some of those benefits materially. The other component, and of course, this is what's called the Lewisian turning point, right? Named after Arthur Lewis. The dynamics of transferring individuals from the countryside or from the rural environment into the urban environment is a very key dynamic in terms of growth, right? When young people grow up on a farm or in a rural environment, if they're looking for opportunity, they want to be able to move to the city where they can actually participate in the modern economy for the opportunities. There are some obviously that want to stay behind, but there's a very key inflection point effectively where the productivity or the value of the last marginal player coming out of the rural environment into the urban environment can actually subtract value from the economic system, right? Because you're removing too much support from the rural system. India is a long way from that. Most estimates are that China actually crossed that point sometime around 2011, 2012. So they're now a solid 12 years past this Lewisian turning point, creating some of the tensions that we see within China, where their economy has become so deeply imbalanced. I wanted to share a couple of charts that hit on a few things, and then we had some really good questions that I wanted to hit on. In particular, there was one asking a question about the differences between our strategies at Simplify and other competing strategies. We're not going to address that directly, but I will actually ask you to comment a little bit on construction techniques, because I think there's some really interesting differences between the construction of the strategies that we're currently using and how those frame in the United States. So let's just run through a couple of quick slides here. The first one is this underlying dynamic of how young India is, right? And I love this chart for two reasons. One, it actually highlights how relatively young the United States is, right? So if we look at this chart here, India, the average age at this point is 29 and a half years old. It's not that life expectancy has been cut so short. It's that fertility rates have remained high in India until very recently. That has created a large youth population that is active and mobile and prepared to move where the opportunities are. Does that seem like a fair characterization, Anupam?
It certainly is. And I'll just make two comments here on this chart. One is that we're extraordinarily fortunate in the United States to have the type of immigration that we have that has kept the demographics in check and kept the country relatively young. Japan obviously is the basket case here because of the xenophobic nature of Japanese society, where they used to be extraordinarily hostile to foreigners. And to think that Japan over the next quarter or so, the next 10 years or so, could lose as much as a quarter of its population. We see the abandoned houses in Japan, et cetera, et cetera. It's quite amazing. But the point I'll make is the only unnatural sort of phenomena that we've seen in the last 50 years that affects demographics is China and the one-child policy. If you think that Japan looks bad today, demographically because of this, wait till you see what happened in China because of the one-child policy. Most economists have been extraordinarily sort of perplexed by what possible economic consequences could be. If I may just spend 1 minute on this. Mm-hmm. Social Security, which you mentioned, Michael, is a Ponzi scheme where we need new young payers to pay for old foggies like me. In 7 years, I will be able to claim Social Security, but I have paid into Social Security the last 35 years. So, okay, it's going to happen. But we need new, younger kids to be paying into, the Social Security system for the older guys to get paid. And once those dependency ratios change, you have problems. In China, when the one-child policy, affects from, however 20, 30 years back hits, you're going to have this problem of very few young people trying to support a very aging population. And as economic growth happens, just like it has in India, and the rest of the developed world, you tend to produce less children. So the replacement ratio, which is about 2.1, 2.2, per family, that number is actually now tipped, and India will see growing population growth as we go. But again, the demographics becoming unfavorable are a long way off. So again, Michael, the thing about demographics is it is destiny, and nothing you can do in the short run to change any of that.
Well, there's certainly something that I could do. I'll have to talk to my wife about it, but that's not going to really work here anymore. If I think about one of the things that I always look for from an investment standpoint, it is actually this concept of scarcity, right? And one of the things that you're highlighting has been a development path around the world, particularly true in developed countries, but also forced or imposed upon places like China. We're now seeing this actually play through elsewhere. Effectively, as we have become urbanized, as we have become more competitive, it's become increasingly expensive to have children who are fantastic and absolutely wonderful on holidays. Harley can speak to this, but they are also quite expensive, aren't they, Harley?
Indeed.
They are indeed expensive. And so this is one of the very few situations in which, in my opinion, people had this story very wrong about China. China was perceived that one-child policy had created a demographic dividend very early on, and it was perceived as advantageous for China that they were spending 40% of their household income in educating their one child. My reaction to that, of course, is, well, if you are spending 40% of your household income educating one child, how many children can you have? And the answer, of course, is only one. You can't have two because you'd then be spending 80% of your household income if you're trying to be competitive. that's created a global shortage of young people. And in India, 42% of the population is under the age of 24. So you've got an incredible reserve of young people in the world's most populous country that are interested and available to become participants in the market economy. Now, if I think about how radical that is going to change, and this is a chart, Anupam, that I apologize that I actually put in here. This is not part of your original materials, but it's looking at the population of China and the United States, or I'm sorry, China and India in particular. There's lots of other countries here. But if I look at them today, they're roughly on par. If I move forward another 75 years, China is less than half the size of India, based simply on these fertility dynamics, right? The only other country, again, I just want to draw attention to people here, the United States is actually growing in a pool of countries that I know people focus on, places like Nigeria. Pakistan is certainly interesting as well. But notice that Indonesia actually falls back in this ranking, right? So we've seen those fertility rates collapse in countries like Indonesia. Bangladesh, I believe, is actually, crazily enough, approaching replacement levels in terms of its fertility rates. Where does India stand at this point in terms of that fertility rate and the replacement ratio?
Michael, I believe that the replacement rate ratio, which is, I believe, 2.1, 2.2 children, whatever the exact number is, I think India is just sort of tipped, across that, where we'll see slowing population growth now moving forward. However, Michael, as you mentioned, with 42% of the population under the age of 24, that becoming a problem, in the near future is not sort of, is not serious. It could become a problem much later, but we don't see that as a problem in a relative sense yet, But I do believe that the same dynamics in China or in the United States of extraordinarily aspirational families, which is very expensive to have children, not just from a education point of view, but from a childcare point of view, from a global consumption point of view, where everyone wants to holiday in all the expensive places around the world, etc. No, that is actually beyond. I believe that we are past that, the replacement rate here in India, and the population will begin to slow down. But that's more the urban, educated population, and it'll take some time to catch up with the rural population.
And if I think about that underlying dynamic, right, so that's really the demographic dividend, where effectively you're describing a situation in which the marginal family is now smaller, less resources have to be spent on educating unproductive young, and I use that understanding the irony. I'm a huge proponent of having children. I think it's the most wonderful thing you can have. Again, Harley and I have done it a few too many times by any reasonable metric, but we're certainly supportive of that, but we also recognize that consumes resources that are then not available elsewhere. If I look at India's growth trajectory, we're again looking at a rate of growth that, quite candidly, China would envy dramatically at this point. Even if I believe the state-sponsored numbers in China today, I would point to India and the growth rate that we're seeing in India. We're looking at GDP per capita effectively starting to move towards doubling over the next decade. So really pushing India into that consumption basket that you were referring to. If I go into this, actually then raises a question. So Chris Johnson asked a great question, which is part of India's growth has actually been a function of access to relatively cheap energy. We're seeing China make huge investments in nuclear to reduce its reliance on imported energy sources. Where is India in that process? They're currently benefiting, candidly, from a world environment in which Russian oil is being priced at a discount because of various sanctions that are being placed on it. This gives India access to a discounted source of energy versus many of its peers. But does India require that, and what is India doing to change its resource base?
Sure. Michael, so I would want to point out that Indian access to cheaper Russian oil is behind us. India no longer is a beneficiary of its ability to buy oil from Russia, priced in non-dollar terms at discounted prices. that's behind us. The Indian emphasis has been on renewable energy. There's huge investments in solar, huge investments in solar, huge investments in wind, all of which will bear fruit much later. But India is a large producer of coal. India is a large importer of coal. So that remains there. And India's been a nuclear power since 1974 and essentially has multiple nuclear power plants around the country that produce electricity for it. So, it is a all of the above strategy. And, if you come and visit New Delhi or Mumbai, Harley, I'm sure you'll do that at some point, the pollution is such that there is no option. There's absolutely no option but to move away from fossil fuels. India was one of the first countries that mandated, that public transport in various cities move away from, pure gasoline-based internal combustion engines to compressed natural gas type engines, which slightly better or much better from a pollution point of view. But there were no choices. There's just no choices. But you see the pollution, not unlike what we have seen in China and certain places where, because of industrial pollution, the air quality is very poor. India has now overtaken China as probably the country with the poorest air quality, with New Delhi and Bombay, etc., competing pretty hard, for that. So, Michael, to the question, whether it's nuclear, whether it's solar, whether it's wind, whether it's fossil fuels, including the worst of the lot, which is coal, India consumes all of that in extraordinarily high proportion. It needs to. It just needs to.
Ask a few money questions over here. Mike, do you have another slide you want to show, or?
Well, I did. Unfortunately, I just realized the compliance took the slide that I wanted to show. So this is the fun part of asset management on occasion when you're dealing with the compliance component. What I wanted to show very quickly was the relationship between valuation and profitability that exists across the portfolios that we're using relative to, say, the S&P 500. And so this is one of these weird situations where I would point to countries like India as being much the stock market in India has a much tighter relationship in terms of profitability and valuation than we see in the United States. I don't think I'm violating anything from a compliance standpoint by observing that in the context of this. That's all I was going to focus on. So go ahead with your question, Harley.
I got two questions here. One is that over the last X number of years on the 5, 10, 20, passive has basically beaten active. And Mike, this is Mike's, bailiwick over here, for a variety of reasons, why this has happened. But nonetheless, unless you're very lucky at throwing darts, passive beats active. So the question is, in India, should we expect the same kind of dynamic there, or is India so different in how it works? Maybe this is your value idea, that an active manager should expect to beat a passive manager given how things set up. And number two, because it might be related, since the GFC, the rupee is down by half. Do we expect this to continue in the next 15 years, and how much risk is there in the currency in the overall investing in India?
So let me take the second question first, which is that again, the rupee depreciating is a function of the balance of payments, where there's a natural sort of 2.5 to 3.5% sort of depreciation expected almost on a yearly basis because of the balance of payment sort of deficit now. Now, the 2.5 to 3% does not happen in a smooth sort of function. It is extraordinarily episodic. It is painful, and it happens very, very in a herky-jerky sort of manner. Now, India's the two factors that essentially control the dominant in determining the balance of payment issues are really the price of crude. Price of crude essentially is 80% of India's import bills, and India is a very large importer of crude. And that, despite two sort of wars in centers of places, including the Middle East and in Europe, that crude has stayed where it is. extraordinarily beneficial to India. Like that's good. Second one is sort of the foreign exchange reserves that the Reserve Bank of India has, which is at an all-time high. It's about $650 billion, somewhere there, somewhere there. Now, moving forward, I would point out that June is a momentous month for India, where Indian sovereign bonds, which were essentially closed off to foreigners till about 10 years back, now are part of the JP Morgan Global Index, and they're also included in the Bloomberg Index, and will start attracting flows into India, for passive flows into India as far as the bond indices go. The only one that's held out so far is the FTSE, which is not included sovereign bonds, and the S&P is essentially upgraded India. It hasn't upgraded the rating, but it's put it on positive watch, saying that the rating change is coming next. So all this is going to tend to sort of flows coming into India, which again should sort of alleviate the problem of the rupee depreciating. Now, Harley, I love to say that the first time I ever got on a plane from India to come to the United States was in 1976. The rupee was 7.75 Indian rupees to the dollar. It's 83.5 today. Okay, and if you look at how that's happened, it has been painful and it's been very episodic, where for the rupees are depreciated very quickly, like that. Moving forward, there could be geopolitical events which cause sort of the rupee to depreciate. It will be primarily from oil shocks and things like that. India remains a large importer of crude, but given sort of the large foreign exchange reserves now, the Reserve Bank is able to essentially absorb those shocks. So I'm not as bearish on the rupee as I used to be, because there are positive catalysts that could happen which could cause it to appreciate. Now, the other thing is that the economy is maturing, it is broadening, deepening, and sort of its dependence on oil, and the level of where oil is trading is not as sensitive as it used to be. Our internal research, and our internal belief at System 2 is simply that up to $105, India is very comfortable with oil like that. It doesn't affect growth in any which way. Once it crosses 120, that then becomes inflationary and so starts curtailing growth. So, again, we've been somewhat positively surprised that in spite of the war in the Middle East and in Russia and the Ukraine, that oil hasn't moved much. Now, first question on active versus passive. And Harley, I believe there that it's more a question of extraordinarily efficient markets like in the United States and sort of the developed world, where passive investing works, and it becomes very difficult for active investing to beat passive investing. And the Vanguard effect in the US, we'll not mention that. But in inefficient markets like India, relatively inefficient markets like India, we see active management almost certainly do better than pure passive management. One of the things I'll point out, even though the market cap of India, as we started out with Michael, at about 4.5 trillion or whatever the number is, or 4.5 trillion, a large part of that is locked up stock still in founders' hands. The float on the 4.5 trillion is about 1 trillion and change, So India, even though as a market, as the market cap of the entire, the market here seems extraordinarily high, but the actual amount of the stock in the public float is relatively less. The other phenomena which has pushed India's markets up quite a bit is if you look at India's sort of weightage in the MSCI EM basket, that has steadily climbed from the last 20 years from 5% to 20%. It's almost the same as China, where the Chinese economy is 5 times that of India, where its weightage in the EM basket, the MSCI and ACWI EM is almost the same, which is incredible. So you have more money chasing less stock.
Mike, do you have any comments on active versus passive in India? Have you done your work on that? Mute. Still on mute.
We had the Alexandria's finest fire department zooming by my short-term rental here. Anupam, I don't know if you know this or not, but I actually am the homeless strategist. I have been traveling all over the United States with short-term rentals for the past couple of months. I'm currently in Alexandria, Virginia, where my office is right next to the street. So I apologize for that. We are absolutely seeing a tremendous amount of inflow in India. It is very natural that that be passive. One of the things that Anupam is hitting on is the dynamic that because India's stock market is so heavily weighted towards insider ownership as compared to free float, the dynamics of passive are naturally more distorted on a market cap basis than we see in the United States. I don't think, and I think this is important for people to understand, I don't think that passive flows are necessarily a bad thing, right? I actually think that they are a simplistic tool that can be used to allocate capital, but as long as they're bringing in capital, that's great. Now, if you actually want to help a place like India succeed, I lean towards the model of Anupam, where you're actively choosing how to allocate capital, trying to find what the opportunities are next, rather than simply concentrate the resources in the hands of the Reliance brothers. So when I think about that type of dynamic, I'm much less concerned about India. And candidly, I'm very excited as I see developments like Anupam highlights, which is the inclusion of India's sovereign bonds into bond indices. That's actually giving India a relative advantage in terms of lowering its rate of return that's required on those bonds. And I also think that actually then plays into the dynamics of the currency itself. The currency, while it has depreciated dramatically, as Anupam highlighted, is slowly becoming less volatile. It is important for people to recognize that if the government is going to run a deficit in which it is funding capital expenditures, part of what is actually transpiring is a recognition that there is always going to be a capital deficit in a place like India, in which the currency used to import that foreign capital occasionally has to concede that, well, we didn't do it all perfectly, right? That's part of the dynamic of currency depreciation, is it gives you the flexibility to make mistakes. My Bitcoin fans out there are screaming into their respective microphones, but you're all muted. The other thing that I would highlight that I think is actually really important, and I do just want to hit on this because we're starting to run short on time. This went so fast, Anupam. It's really fantastic. Let's see here if I can show this here. I don't know why it. There we go. One more time. Share the screen. There we go. There it is. So this is actually looking at this dynamic of flows. And one of the things that we're very clearly seeing is that India and China are starting to swap, right? So we're seeing a downgrade of the weights in China in MSCI type indices and global market indices. We're seeing an increase in India where it's still roughly half the market capitalization of China, but it's gaining rapidly. That's bringing new funds into India, et cetera. So I'm actually quite encouraged by that component. Do I think it's ideal? Do I prefer to see the funds directed in a thoughtful, individual manner? Absolutely. But on net, I got to say at this point, I think passive is actually helping India more than it's hurting it. I don't think the same thing is true for the United States. Okay, I think that's, since I can't share that slide with the valuation, I'm so bummed out because it's a great slide. We'll have to have people reach out and ask for it because it can be distributed in that manner. But there is this overall component of the way that you've constructed your portfolio suggests to me that you're at heart a little bit of a value investor. Is that a reasonable interpretation as we think about the opportunity set going forward?
Michael, I would differ slightly from that. We are focused purely on consumer growth.
Okay.
All the entire conversation over the last hour or so has been on this rapid sort of internal growth here. So we, in a sector agnostic way, in a market cap agnostic way, look at sort of consumer growth. We look at like what is driving the Indian markets, and we sort of focus on that, even though we have sort of guardrails as to how much exposure can we have in a particular sector, a particular industry, and things like that. Consumer growth stocks in India have always been very expensive. And they continue to be because of the extraordinarily long runway that's available to consumer stocks as more and more people join the middle class and begin to consume in earnest. So that's been recognized for a long time, and consumer stocks have always been expensive in India. So if you look at our sort of average market cap or median market cap, it's lower than that of the major indices, primarily because the major indices are heavily skewed, which are market capitals based on market capitalization. They're heavily skewed towards large IT stocks, large energy stocks, large pharma stocks, all of which are export oriented and have little to do with domestic growth in India. So we believe that the story really is domestic growth in India, and we are focused on that, and that causes sort of fees there in our portfolios to be up quite significantly. Now,
that's super. I just want to pause you for 1 second there, then, because I'm going to reclassify you then, because I definitely see a valuation sense in how you order your portfolio. However, right, there is that underlying dynamic. You're certainly aware of it, but it feels like what you're actually saying is, no, Mike, I'm much more of a Phil Fisher type growth investor, in which you look at the valuations not relative to what they are today, but relative to that nearly exponential type growth that you're looking at in the future.
It will be more of the traditional corp-like growth at a reasonable price. The factor that's dominant in Indian markets, the most resilient, is quality. And that's what quality we're focused on completely, because that's a combination of growth and value, in my opinion.
So that would explain the layout that I see in your portfolio. If you're ultimately applying a GARP type measure or quality bias, you're drawn towards companies that have less reliance on external capital, far more ability to fund internally, et cetera. That shows up in the valuation frameworks. All right, Anupam, you have been so generous with your time. It is now 3 o'clock in the morning in India. Harley is getting very hungry out in California. He's thinking about going to that New Delhi. So bringing us back home, we're going to ask Bobby to wrap it up for us. And I really appreciate everybody joining us. Thank you so much.
Thank you, Michael. Thank you, Harley.
All right. Thank you so much, Anupam. It's been a privilege to have you on Thursday afternoon and morning for you. Thank you, audience, for joining us. The replay of today's episode will be available next week, so look out for that email. Also, please don't forget to register for our next Keeping It Simple on July 11th. We're going to have Neil Howe, who is the Managing Director of Demography at Hedgehog Risk Management, who will be discussing with Mike and Harley some interesting cycles and seculums. So that's all for now. Thank you so much for joining.